Good evening, everyone. It's great to have you all here for today's session on actuarial valuation. I am Dribjot and I'm joined by my colleague Miss Twinkle, and both of us will be guiding you through this webinar. I hope you are excited as I am because we have a lot of valuable insight to cover. Begin. Let's take a quick look at the agenda for today's session on actuarial valuations. We'll begin with the quick introduction to the actuarial valuation, means what it is, why it matters, and how it connects with the employee benefits and financial reporting. Then we will move into the key components of evaluation. Firstly, we'll talk about data and assumptions, since accurate inputs are foundation of reliable results. Next, we'll look into the valuation methodology and results with a focus on how liabilities are calculated using projected unit credit method. We'll also discuss actual gains and losses in detail, including what causes them, how they impact the P&L or OCI under different standards. We'll touch upon some additional disclosures like maturity profile, sensitivity analysis, the discontinuance liability, which improve transparency and audit readiness. And finally, we address some common audit queries, the type of questions that typically come up during the financial review. And by the end of the session, you'll have a clear understanding of how to interpret actual valuation and the story it tells about the employee benefit obligation. So, what's actual valuation? At its core, it's the process of measuring a company's financial obligations for employee benefits like gratuity, pension, leave, and post retirement benefit medical plans. But it's more than just a technical calculation. It can be referred as a strategic tool. Using assumptions like attrition rate, salary growth rate, mortality rate, retirement ages, we estimate the timing and value of future payouts. Actual valuations serve different purposes. For funding, they guide how much to set aside today. For settlements, they help estimate transfer amounts. And most commonly, they are used for accounting under different accounting standards such as AS 15, NDS 19, IS 19, US GAAP. Ultimately, this process ensures a true and fair view of the obligation, realistic expense recognition, and consistency in financial reporting. In short, actual valuation plays a critical role in telling the company's financial story and is essential for informed decisions by management, auditors, and investors. Now let's look at the four key components of this process. You'll see the slide lays out four key components like slices of a pie. And that's no coincidence. Each one is very critical. If any part is off, the reliability of the valuation can suffer. Let's start with the most fundamental one, the data. As the saying goes, if you torture the data enough, it will confess. It's light-hearted, but it in actual work, it's very true. Inaccurate or incomplete data like wrong date of joining or missing salary or in fall in salaries can throw the entire liability off. The kind of data we collect depends on the benefit. For gratuity, say we need date of birth, date of joining, salary, policy details, and all those things. For leave encashment, we would need say closing leave balances as on the valuation date, the accumulation policies, and all. So before any valuation begins, we always do a sanity check, or it is recommended to do a sanity check to ensure completeness, accuracy, and consistency in the data. The second component is the assumption. As the slide says, valuations are only as valid as the assumptions. Again, very true. We use financial assumptions. Typically, we use financial assumptions and we use demographic assumptions. The financial assumptions include your salary growth rate, your discount rate assumption. Demographic assumption includes your attrition rate, mortality rate, retirement ages. These aren't arbitrary. We cannot just take a random number. They should be based on your company's experience, industry benchmark, and a broader economic factors like government bond yields. Next comes liabilities and expenses. Here, we use the data and the assumptions to quantify the numbers. What's the company's obligation today, and how much of that should go into this year's financials? Means what is the liability and how much to book the expenses during the year. More importantly, we understand why the liability has changed the way it is. It has. Was it due to say salary hike, any assumption revision, or any experience variance, or any data correction, policy correction, number of reasons. And finally, we have the disclosures. This is where the numbers connect to the financial reporting through reconciliation tables, sensitivity analysis, and maturity profiles. These not only support compliance but also simplify audit discussions and ensure clarity for all the stakeholders. Let's now zoom in each of these components in detail. The first component is the data. This might sound simple at first glance, but trust me, actual results are incredibly sensitive to the data quality. Even the most sophisticated model or well set assumptions can't compensate for the bad data or incomplete data. That's why data sanity checks are a fundamental part of the process. And this isn't about running a few Excel filters. It's about really understanding whether the data tells a consistent and logical story. We usually bucket our checks under three major themes: completeness, accuracy, reasonableness, or consistencies. First up is completeness. This means checking whether all the required data is present and nothing critical is missing. Because even a missing or an incorrect date of joining could understate service by a few years, dramatically underreporting the liability. For example, we check for things like date of birth, date of joining, salaries, whether they are falling, whether they are missing, whether any transfer employees are there, all sort of things. We look for duplicate records, which surprisingly crop up more often than you would think, especially when the data is pulled up from different sources. Next is accuracy. Here's we are asking, is the data valid in the right format? Say for example, is the date of birth provided is in the right format? The date of joining is provided, whether it is in the right format or not. Another example could be, say, is the gross salary where it should be in, say, leave availment, or is it the basic salary that has been provided by the company? Is the data format consistent? Means the salaries which has been provided are those monthly salaries for all the employees, or is it a mix of annual salary and monthly salary? So, and even in case of funded plan, are we working with the book value or the market value of the assets? The difference can significantly alter the funded status. Sometimes these things aren't evident at first glance, but a quick formula check or comparison across employees often reveals inconsistencies. Finally, we check for reasonableness and consistency. Here we ask them, like, is the minimum or maximum, say for example, is the minimum or maximum age of an employee at joining reasonable or not? If someone has a date of joining of say 12 or 80, it's probably a typo or a wrong date of joining. Are there any fall in the monthly salary? Is the benefit amount paid to the exit employee consistent with the provision booked in the books of account? For example, the company had paid 40 lakh rupee worth of gratuity, but the actual valuation for gratuity is being done on a 20 lakh limit, right? So they are not talking to each other. So these needs to be raised with the company. We need to be solved before the valuation. This completes the data check process. Obviously, this is not an exhaustive list. At times, the type of data check depends on the type of benefit scheme. Also, I would like to reiterate that a valuation is only as good as the input. So, taking the time upfront to get the data right saves hours of confusion later. Now, let's move on to the assumptions, another key building block of the valuation process. Now that we have looked at the role of the data, the next big piece of the puzzle is actuarial assumptions. Now, these are really the backbone of any actuarial valuation, because let's face it, your liability today is a projection of benefits that might be paid 20, 30, even 40 years down the line. And to get there, we need to make educated estimates about the future. That's where the assumptions comes in. We have broadly classified them into two categories: financial assumptions and demographic assumptions. Let's start with the financial side. These typically include your discount rate assumption. This is used to bring future cash flows back to the today's value. In India, it's usually based on the yield of government bonds with a term matching the expected benefit payments. Salary growth rate is next. Which reflects the expected future salary increases, which will directly impact benefits like gratuity and leave. This should account for both inflation and career progression. Expected return on plan assets for funded scheme. This is an important for assumption for calculating the expected interest in income, expected interest income, which impacts your overall expenses. On the demographic side, we have mortality rate. This is about estimating the probability that a person will survive to a certain age. In India, a common table uses IALM 2012-14 year. Attrition rate, also called employee turnover rate, it's about how likely employees are to leave before retirement. This varies widely between industries and job level. Retirement age typically assumed to be 58 or 60 or even 65, unless the company policy dictates otherwise. Leave utilization rate, specifically for leave valuation, this reflects how much accumulated leave is likely to be availed by the employees. So all these assumptions need to be realistic, justifiable, and that means they should reflect the company's best estimate of future trends, not just an arbitrary number or just last year numbers used. Now, how to actually set the assumption? So, how do we actually arrive at these assumptions? It's a mix of couple of things. The first thing is company's own experience, like resignation trend, promotion history, salary revision policies. The second is industry benchmark. For example, in attrition rate in hospitality sector is usually observed to be very high, right? That can be taken care, that can be used as a basis. Third is economic indicators for setting discount rates. Say, for example, for setting discount rate, we use government bond yields, right? And of course, inputs from the management, auditors, and actuaries to ensure alignment with the reporting standard. For example, even if the past trend is showing us an increment of say 8%, but the company expects or the management believes that in future years, say 4 or 5 years down the line, or even 10 years down the line, on an average, the increment would be around 10%. So that should become a basis for the actual valuation.